Investing in the stock market is one of the best ways to build wealth, but choosing between index funds and individual stocks can be challenging. While index funds offer stability and diversification, individual stocks provide higher potential returns, but with greater risk. Which is the better choice? Let's explore both options in depth. What are index funds? Index funds are investment vehicles that track a specific market index, such as the S&P 500, NASDAQ 100, or Dow Jones Industrial Average. Instead of picking individual stocks, you invest in a basket of companies that represent a broad section of the market. Advantages of index funds. Diversification. By holding hundreds of stocks, index funds spread risk across multiple companies and industries. Lower risk. Since they track the market, index funds tend to be less volatile than individual stocks. Minimal effort. Index funds are passively managed, meaning they don't require constant monitoring or research. Lower costs. They have low expense ratios, meaning fewer fees compared to actively managed funds or frequent stock trading. Consistent long-term returns. Historically, major indexes like the S&P 500 have returned 8–10% annually, making them reliable for long-term investing. Drawbacks of index funds. No outperformance. Since index funds simply follow the market, they can't beat it like some individual stocks can. Lack of control. Investors don't get to pick specific companies. They must invest in the full index. Slow growth. While steady, index funds typically don't deliver huge short-term gains. What are individual stocks? Investing in individual stocks means buying shares of specific companies based on research, performance, and future potential. Unlike index funds, where you own many stocks, individual stock investors pick companies one by one. Advantages of individual stocks. Higher growth potential. The right stock picks can dramatically outperform the market. Companies like Amazon, Tesla, and Apple have generated massive returns. More control. Investors choose exactly where their money goes rather than following an index. Dividend income. Some individual stocks offer higher dividends than index funds, providing passive income. Greater flexibility. You can buy, sell, or hold based on company performance and market conditions. Drawbacks of individual stocks. Higher risk. A company's stock price can be highly volatile, meaning investors can lose money quickly. Time-consuming. Picking winning stocks requires research, monitoring earnings, and understanding market trends. Hard to beat the market. Even professional investors struggle to outperform index funds consistently over time. Which is right for you? Choosing between index funds and individual stocks depends on your investment goals, risk tolerance, and experience level. If you prefer a low-risk, hands-off approach, index funds are a safer, long-term option with steady growth. If you're willing to research and take risks, individual stocks can generate higher returns but require effort and patience. If you want a balanced approach, a mix of index funds for stability and individual stocks for higher growth potential can provide the best of both worlds. For most investors, index funds are the best choice because they offer diversification, steady returns, and lower risk. However, if you enjoy researching stocks and want the chance to outperform the market, individual stocks could be a great addition to your portfolio. No matter what you choose, the key is to start investing early, stay consistent, and think long-term.